The main idea of this seminar is to have an enhanced financial modeling expertise for you guys, right? What I'm going to try to do every week is on Wednesday, I'm going to post an exercise that we're going to solve next Tuesday, right? Unfortunately, they didn't have Blackboard available until Monday, Sunday night. That's what I figured out that everything was working on. So I decided, okay, let's not do this on the first class, but we're going to start jumping into these type of valuation scenarios, or at least forecasting scenarios, modeling scenarios, right? In every single class, right? You're welcome to try it, right? It's not going to be evaluated, right? But it's going to be a lot more helpful for you to try to do at least the estimation in your own way, right? Obviously, you can build upon the things we're going to be learning in the course, right? That's going to help you solve or work it out in each one of the exercises or each one of the cases that we're going to present. As you know, this is the first time this seminar is being taught, right? So that means that I'm still debating between cases and a couple of exercises that I'm developing. Bear with me, but my goal, my commitment is to post everything on Wednesday, right, night, and then you're gonna have a few days, right, to solve it out, so everybody can come up with a good understanding, right, of what we're gonna be developing. The main idea is to discuss a couple of modeling techniques, right? What works, what does not work, what are we going to be doing when we iterate, right? Is there going to be any issue if we Monte Carlo simulation? Is that going to be helpful or not, right? And as we're going to be working out, well, when that's it, we can make a sensible assumption, right? Like a gross assumption regarding something. We're going to need to do that in some cases, and how we're going to solve those problems very quickly. Basically, we're going to be using all these techniques, right, for evidently valuing companies, right, but also for analyzing particular deals that are going to be helpful for the enterprises we're going to be working on, right? Anything regarding financing, anything regarding potential acquisitions, that's where all these modeling techniques are going to be useful for us in general. The main idea is to go step by step, right? As we're going to go through the syllabus, you're going to realize that we're going to build upon each one of the different elements in the financial statements, right? And the main idea is to figure out how everything interrelates and come up with a good understanding how to solve any recursive problem that usually arises when you are modeling the three financial statements, the different financial statements, right? Where we can break that recursive iteration that usually arises, right? And how we can solve for that very easily, or how we can model that in different scenarios and simulations. That's the main idea. We're going to forecast and develop pro forma financial statements, right? The difference with pro forma is basically twisting some of the different assumptions that are going to happen, right, to come up with what will occur if we analyze or modify a different variable, right? A different assumption that may change how will company will perform in the future. And that's where sensitivity analysis and scenarios play a significant role, right? We're going to do some tornado evaluation, right? If you have realized that is how the value of our company, right, or a particular indicator that we may define may change, right, may vary according to a driver, right, that we may define, such as, okay, what is the growth of other revenues that we expect, or the GDP growth, or how do we expect to occur reduction in costs, right, in general, and those type of things, right, are going to impact our the sensitivity of our valuation or a different indicator that we may consider as a whole. We're also going to analyze some particular accounts, right? When we forecast depreciation, when we forecast debt, you usually have to develop a different tab and figure out a schedule for this, right? And logically, these become quite. We are trying to come out with the free cash flows, right? the cash flow that you're going to be using for the typical valuation that we're going to be performing. We're also going to drill into what is an M&A model, right? We're going to consider, okay, what will happen if we decide to go with an acquisition and we merge with a particular company? How are we going to develop a pro forma financial statement for that situation? And in what sense we need to consider that this merge, or the way we pay for this merge, right, is going to create additional value accretion or a destruction of value dilution for particular shareholders in our company, right? Either for the acquired shareholders or the target shareholders, right? We're going to analyze those different issues when we are modeling this particular transaction, such as an M&A. So basically, the idea is that you're going to have the key elements that are going to help you build from scratch, right, a particular financial model, right? Uh, Obviously, when we are going to be working through this seminar, we're going to use several templates, right? Um, there's one that I prefer, but I obviously not going to impose. I'm going to try to use different ones that are going to consider different scenarios of different situations, such as the one in the example that I have posted that we're going to be looking into in a bit, right? So it will actually depend on the availability of information, right? How much data do you have? How much access to info do you have? In particular, that's we're going to realize it's going to be critical to figure out how much details on the company we're going to be capable to get as part of this structure. Regarding evaluation, there's going to be a evaluation project, right? The main idea is to have this due a couple of weeks before we end the course, right? 2 weeks before the end of the course. That's what I'm thinking. Regarding time, I'm hoping that you apply all the modeling techniques that we have learned here, right? In order to solve this evaluation project. Obviously, what I'm expecting is that you figure out a company that you would like to value and apply correctly all the evaluation techniques that we're going to be discussing in here. Yes, we are not going. Yeah, we're going to not that companies are going to be repeated among the students. So it's first come. No, it's going to be in groups of up to 2 persons, right? So let me just put that out. Yes, the project. It's in groups, up to 2 students per group, right? And yes, the main idea will be, so I want to give you 2 weeks. Let's make it in week 3, right? That we define which companies you're going to be valuing that you would like to value, and what we're going to be doing is first come first serve. The first one to claim a company, right? Get it. So I'm gonna ask anybody to come up with everybody to come up with the names of the company you would like to value according to what we have been discussing. So we're going to be having first of all we're going to be doing a revenue forecasting for next class, right? The main idea is to figure out how can we forecast revenue, right, from different perspectives as we're going to be seeing in that class, right? We're also going to analyze cost forecasting. What should we be considering? Where should we where are going to be the main caveats when we work it out some cost analysis, right? All the different problems that you have with fixed costs and all the issues that you have with variable costs as part of a normal forecasting that you're going to be seeing. With that, it's going to be very easy to figure out the income statement forecasting, but logically, then you have to build upon, right, all the issues regarding interest expense and taxes, right, that I just want to touch base and be sure that everybody is on board on that. Regarding the different issues that normally arise, right, when we are developing that. Then we move very quickly into balance sheet forecasting. That's very easy. We're going to go to the major accounts there, right? We have to distinguish between the key accounts in the balance sheet and the minor accounts, and logically there's going to be a few of them when you forecast that are going to assume constant for simplicity purpose, given the fact that they are not that important, but we're going to be working each one of them independently as part of our analysis. Then we're going to be moving into a statement of cash flow forecasting as part of our order, right? The main idea here when we're going to move into a statement of cash flow, right, is logically to build upon what you're going to be needing for free cash flow calculation, right? So remember, statement of cash flow for it's an accounting, right? Um, it's an accounting statement that's basically consider all the different sources of cash, right? The operating source of cash, the investment, either source of use of cash, and the financing source of use of cash, right? But the free cash flow builds upon how many or how much are the cash flow for the whole enterprise, right, that the enterprise is going to be receiving, that can be divided among the debtors and the equity holders, right? We're going to try to build upon that as part of that. Then in week 7, we're going to be working or integrating, right, the 3 financial statements we have been discussing to come up with pro forma financial statements, right? Analyzing not only the forecasting, but the different changes that may appear or may impact these 3 financial statements, right? Given some changes on key assumptions. That's going to be the main issue. We're not going to have week 8 because that's the midterm exam, right? With all the other courses, we do not have a midterm, right? On week 9, we come back and discuss about sensitivity and scenario analysis, right? You probably are very familiar with the typical base case, optimistic case, or worst case scenario, right? That's the typical idea that you will see. But the key element here is to figure out what are the drivers, right? When we're going to be modeling, most likely you have done the typical 2-entry table, right, with the weighted average cost of capital or the discount rate as the sensitivity of the value of the company, or the long-term growth rate at the sensitivity of the value of the company. That's okay. That's a very good way to come up, or a typical way to come up with evaluation. But you also need to go a little bit farther, right? When you are valuing this, you need to figure out, okay, what are the key assumptions that are making all the changes in my valuation, right? Is it the price of the key item that I'm selling or producing, right, or service that I'm giving? Is that the number? Or it's a particular operational metric, right? From industrial company, it's the throughput time, right? It's the time that everything goes through in the manufacturing process, right, to come up with the final good. Is that the issue that it's actually affecting my company? Or is it something regarding productivity, right? If we are talking about agriculture companies, right, or an agriculture project, the productivity of the land, right, results as a critical element to figure out how much value am I going to be able to obtain from a particular project or company. So those type of things are going to become a lot more important when we analyze the sensitivity and assumptions that are going to be upon our models, right? Then we're going to jump into the typical valuation framework, right, where we're going to be discussing weighted average cost of capital and adjusted present value approaches. Those are the most common approach to value a company that we're going to be considering, discounting free cash flows right to the present as a way to come up with the enterprise value that we're going to be seeing in our models, right? And then we go into the specific items that I mentioned, right? We're going to drill into depreciation forecasting, right? For all those other models, we're going to make a gross assumption regarding depreciation. Then we're going to elements on week 11. And on week 12, we're going to go into debt forecasting, right? As a way to figure out, okay, how are we going to be capable of getting the necessary financing for our company in the coming years, right? As a way to correctly finance the operations that we're going to be expecting to occur. Then we drill into equity issuance, right? That actually basically is related to the valuation. How are we going to be capable of getting additional financing, right? From other shareholders, right? Such as selling a minority stake or selling our company, right? That's basically what we're going to be considering when we are not get into week 13. And just to finalize, on week 14 and 15, right, we drill into the M&A environment, right? Thinking about all the M&A modeling that we're going to be needing, thinking about synergies that may arise, thinking about cost-cutting alternatives that may occur when we merge with another company, and all the necessary diversification that may occur if you are correct merging different companies as a whole. And finalizing with all the accretion and dilution that we are going to be thinking about after an M&A transaction has occurred. Well, how many of you are taking or will be taking the CFA? Okay, so most of you are taking advantage of being at university and taking this. For those of you who are not familiar, I hope everybody's already familiar. Uh, the Chartered Financial Analyst certification, right? It's kind of a standard in the investment community right now as a way to certify that you not only have a good university degree, but also you have, right, regarding investment and financial analysis in general, right? We have 22 or so, almost all of you are actually taking it. For those of you who are taking it, you may want to share this with your other classmates. And there's an additional certification or additional program related to the CFA Institute, right? It's the Investment and Foundation Program. And the cool thing about this program is that it's free. You have 6 months to take all the exams, obviously are very similar to the CFA, right? For those of you who have taken level 1, probably this is going to be very easy regarding that. And for those of you who are not thinking about taking the CFA but would like to get some additional certification, right? It seems like a very good alternative at no cost, right? And everything is online, even the exam, right? Which is one of the challenges that we are facing with the CFA, because it usually was uh, uh, in presence exam, right, taken with the students, and it's going to be some time before we're going to be capable of doing that. So the CFA Institute has come up with this alternative for anybody who wants to go into some certification, right, without all the hassle or without all the necessary um, requirements that are common to the CFA, right, as a whole. They're still doing the CFA, obviously, right, as part of as the leadership program, and it's a very good certification that is being had and it's being promoted by all the um, finance professionals, right, in the investment community, right? Um, but it's a very good alternative if you are not thinking about taking the CFA to get an additional certification here, right? By the way, the CFA Peruvian Society is the CFA Peruvian Society, Peruvian CFA Society, right? A conference this Thursday, right? Just in case you didn't check it out, it's online and free structure. I'm just looking into El Dorado Investment, whose owner and leader is Melvin Escudero. He's the one who's usually preparing this type of seminars. Let me just quickly get into that one. I think I have it in my calendar, but it's actually easier if I post his. Here it is. No, this is from today's. Right now, I don't want that one. It's actually conflicting with us. Oh, I'm gonna post it. Okay, this is gonna take a little bit longer than expected. I'm gonna post the one that we're gonna be needing in a bit, right? I'm gonna post the seminar. It's gonna be on Thursday, and it's gonna be done with who's the guy? It's from Integra FP, if I recall correctly, who's gonna be presenting some of the different issues regarding investments right now in the in Peru and Latin America, right? As part of the normal investment that Integra FP usually makes. So regarding the project, right? The project can be a local or an international company, right? I completely understand that for matters of information, right, it is a lot easier to come up with some data from companies that are outside Peru, that are public in a stock exchange outside Peru, right? The companies here do reveal information, but companies outside, such as the ones in the New York Stock Exchange, are required to reveal a lot more data, right? So yes, you can actually do the evaluation either on companies here or locally or internationally if you prefer to, right? Please keep in mind, just in case you are in the final semesters and you're thinking of using this as part of the typical evaluation you're going to use for investigación financiera. Keep in mind that I'm a junior there, right? So I kind of know almost every company that is being presented or has been presented in Investigación Financiera, just in case, right? The main idea of the project is to perform evaluation, right? I'm not expecting a pitch. It's not a presentation type of things, right? Unfortunately, we only have 15 classes, so I rather have this as a hanging, right? That is going to be evaluation of a particular company. I expect you to go with a type of evaluation that we're going to see is going to be more closely to a bottom-up approach, which is going to be thinking about more detailed information of the company, right? Basically forecasting the financial statements and coming up with the enterprise expect for the company. As we're going to go in the different classes in the different weeks that are going to follow this one. We are going to develop a lot of sensitivity analysis, right? I also expect you to do some sensitivity analysis here and come up with the best valuation you should imagine for a particular company. The main idea for me, obviously, is not to uh, come up and say your valuation is completely incorrect because you're assuming a wrong discount rate, right? But rather figure it out if you are correctly applying the necessary techniques that we are going to develop here, right? And obviously, if you're not making a silly mistake in any one of our calculations, right? Unfortunately, that's something that may occur in several evaluations that we're going to be seeing, and there are a lot of going to be mentioning along the course where people normally make mistakes, right? And that's what I expect you to solve it with. Okay, I think it's be better if I develop for week 3, right? Let me put it for week 3, handout with all the details of the project, right? What I'm expecting, what should be expected, so everybody is on the same page regarding what I'm gonna be evaluating and what I expect you to develop in your project, right? Let's better do that as a handing so everybody is fully aware of that. Why are we doing this financial modeling in general, right? Why are we trying to come up with uh, this different forecasting that we are thinking about, right? So there are several issues that normally revolve in the finance department, right, where you're going to be modeling the financial statements or at least modeling the cash flows for a particular project or the whole company. When considering that, the first thing that should come to your mind, right, the strategic planning and budgeting that usually come up in the financial planning arena, right? If you are working in finance inside a corporation, it is very likely that you're going to be the one trying to come out what's going to be the future for the company in the next year, right? And in particular, if you're in strategic planning, what's going to happen for the company in the next 5 to 10 years, right? Thinking about all the different forces that are going to be affecting, right, the company performance, right, and incorporating that into the model. So that's where all the informations that we are useful from industrial organization in economics, right, or from business analysis, right, or Porter's five forces, right, if we want to think of from a business perspective, come in handy, right? We need to be thinking about, okay, what's going to be our customers, what's going to be our suppliers, what's going to happen with our competition, what are the possible substitutes we're going to have, right? What happened with all our complementary products, right? The main ideas that are going to be affecting our company come in mind when we are thinking about this forecasting analysis, right, from a strategic planning perspective, right? And the same things go with industrial organization analysis, right? Coming out what's going to happen if there are major changes in our industry or in our market, right? Right now, with all the possibilities of mergers that are being presented in the current environment, right? You need to think about, okay, what's going to happen with a lot of horizontal integration or vertical integration regarding potential competition, and if that's an opportunity for our company or a be affecting us, right? So that typical SWOT analysis, strength, weakness, opportunities, and threat. You are familiar with you're familiar developing, right? It's gonna be kind of handy when we are trying to test the forecasting we're gonna be performing in these models, right? The other potential use of our models obviously is project evaluation, right? As typically will occur, companies do develop new projects, new expansion opportunities, or possibilities to introduce a new item, a new good, or a new service into our particular economy, right, in a particular market. And logically, we're going to be developing a financial model specifically for that project, right? And that's something that is quite of interesting, right? Because we're going to be dealing with the issues of subsidiaries, right? That may actually have their own capital structure different than the one of the holding company, and we are also going to be capable there to analyze the of obtaining some tax exemptions, right? If we are, for instance, if we are, for instance, developing a project in one of the different um, industries that are being promoted by the government, right? So if we go with, for example, these ecological buildings, right, that have a lot of reduction in the carbon footprint, right, that may be actually that's is going to create a tax shield, right, that's going to create a reduction in tax payment for the particular project, right, compared to what occurs with the holding company. So those type of things need to be considered in general, right? Even financing, right, for some of these particular projects are going to be different or maybe different than the holding company. From the idea that if there are less risks, right? If, for instance, they are capable of getting financing from multilateral organizations, or if they are more risky, if you think about project finance, right? If you think about we're going to develop something that is a lot more risky than usual, such as a particular um, project in infrastructure, right, that may be financed by multilateral organizations with some guarantee from the local government. That's the usual idea. We're also going to develop models when getting some debt financing. I don't have to mention that. If you're working right now on a bank or if you're working for advisory in general, right now you're going to have a lot of company evaluation, or better said, cash flows of these different companies that need to be evaluated to figure out if they are solid enough, sustainable enough to get some financing, right? So if you're in the bank, obviously you're gonna have a more conservative approach, figure out how are you gonna be capable of providing money, providing funds to these particular companies, right? Um, And in contrast, in during the advisory side, right, you're the one who's gonna try to figure it out what is the best way to correctly structure the debt in order to get that financing from the banks or from other debtors, right? I'm thinking about investment funds, for instance, that are giving some financing. So we need to create the correct structure in order to get that financing, right, as part of the whole ordeal. Um, as I was mentioning, the current situation with the COVID that is affecting several industries, right, have created several issues regarding this financial model. So you probably read in the news, right, that one of the critics regarding the Reactiva Peru financing, right, when they were starting this process was that if the government was supposed to give a complete guarantee over the loan, right, then the banks were not going to be so good as evaluating these companies, right? And may end up providing funds, providing public funds, right, to companies that did not have any potential to survive, right? Any potential to continue operating. So part of the whole idea regarding Reactiva with the 98% guarantee from the government for small companies, right? That were only getting financing of less than 200,000. It's basically an issue of moral hazard, right? Because what's going to happen is since the bank is thinking that all the credit was going to be repaid by the government, right? There's not going to be any analysis. We are going to be getting some companies that are receiving this financing where they were either not as with so not good perspective, or that they were having some formal issues, right? And they were just receiving the money for free with a very low interest rate. One of those companies that you can read in the news was this bar that was in the Olivos, where this trial occurred over the weekend, right? But coming up on the debt financing arena, right, as I was mentioning, you need to think about probably outside the box, right, regarding this financing. Uh, for instance, in when we are going to be modeling, right, in some of these structure, we're going to realize that in some situations the flows are not going to be enough to guarantee uh, this particular financing, or maybe the cash flows are going to be enough by the interest rate that they are putting on top of us, right, are making it impossible to repay, right? So we need to come structure correctly the financing in order to reduce that interest rate. And we're going to discuss very quickly, and when we talk about the scheduling, what are the different types of guarantees that we can put on top in order to reduce the interest rate that the bank is charging us, right? Or other institutions are charging us. For instance, and the most typical ones, as you probably have realized, are mortgages, right? If we put some mortgages, not necessarily from the company, but from the shareholders, for instance, right? From additional land that they may have, or additional buildings they may have, or houses, that may allow us this rate. And we can also go a little bit farther, right? With a structure similar to a trust fideicomiso, right? We can create a trust that is going to receive all the money necessary to repay the debt, right, to our bank or to our debtors. It can be an investment fund that is financing us, right? And in that instance, we can even go even farther and figure out we can also get what is called credit insurance, right? So we can get insurance company to give us a policy that we endorse to the bank, and if by any chance we fail to repay the bank, the insurance company is going to be the one taking or repaying that debt, right? So those are the type of things and obviously for this insurance company, we pay a fee every month, right, in order to get the necessary financing. So we can structure this in different ways, right? And that's going to be part of the idea when we are going to be modeling debt financing as a whole. But at last but not least, right, when we are going to be modeling, we're going to be thinking about valuing the company or getting some equity financing, right? Equity financing us to value the whole enterprise or the whole operations of the company and come up with some number, right, for the minority stake of our company, right, or for a majority stake if we plan to release control to somebody else, right? And this also applies for a particular acquisition that we may want to perform, right, as such in an M&A transaction, right? We need to think about what's going to be the different cash flows that we're going to be obtaining in order to come up with the correct valuation as a whole. Just to recap very quickly, um, the different techniques that we're going to be thinking about when valuing a company, right? We're going to touch base on both of them, as I mentioned, which is the weighted average cost of capital, right? The one that is most commonly used where you do consider the cost of equity and you consider the cost of debt and you weight it out, and the cost of debt is going to be adjusted by for taxes, right? For the interest taxes that are normally considered. You're going to be using that at the discount rate to discount the free cash with the enterprise value. That's EV over there, right? In contrast, there's another approach, right? That probably some of you have already heard about it. At least the ones who were my students, I assume they remember it, right? Which is the adjusted present value approach, right? And the adjusted present value approach differs in the sense that you are going to be modeling those interest tax shield benefits, right? So all the interest tax benefits that you normally get, right, are going to be modeled separately, right? So we're going to be calculating the free cash flow using the discount rate as the required return on assets, which is the unlevered discount to come up with the value of the unlevered company. The value of the unlevered company refers to a company that has no debt, right? So that first element that we're going to be having here, right, this first element over here, is going to be calculating what is going to be the value of a company with no debt at all, right? And then we're going to be adding or considering the additional value that is obtained by the company by getting those interest taxes, right? And we're going to discount those interest taxes at the appropriate discount rate. In this case, it's going to be the required term for interest taxation. We're going to figure that out, right, when we are going to be working this on week 12, if I recall correctly. Nothing quite complicated, and we're going to drill into the basics regarding those calculations. So as I mentioned before, the weighted average cost of capital is the most common approach, is the most familiar approach, popular that you're going to see, but the adjusted present value is getting a lot more support, particularly because it's very useful to value a company that has a change in capital structure, right? Such a company that has increased its leverage and is planning to decrease over time, right? You do realize that if that is happening, if the capital structure of a company is varying through your forecasting period or is varying in the following years, right? The weighted average cost of capital approach do present some difficulties because it does assume a constant debt over debt equity, equity over debt plus equity, a constant capital structure. Obviously, you can calculate a weighted average cost of capital for each one of the forecasted years, right, as a way to try to correct for this issue and come up with a better estimation. Um, the problem that's a good way to solve that problem in general. But for instance, if the company has has losses, right, and is not going to pay taxes for a few years, right, then the capital approach becomes moot. It's not going to be helpful at all. And this other approach, where you're going to be valuing the interest structure separately, becomes a lot more useful. But we're going to drill into that, as I mentioned, in the coming weeks, right? Okay, so just to quickly reinforce this, and let me quickly ask you the typical thing that we're working on. Let me just check here. Okay. So the typical thing we're going to be working on are the forecasting of the income statement and the balance sheet, and from that we're going to develop the statement of cash flows, right? So who can quickly let me know how are these interrelated? What are, for example, what is the key element that relates the balance sheet and the income statement? Okay, so retained earnings, that's the good thing, right? Net income that occurs in the income statement flows into your balance sheet in retained earnings. Okay, yes, yes, we have three products that quickly jump out, and that's correct, right? That's the main issue where the income statement is related here, right? Um, then I know this is also a two-way line, right? So how the balance sheet from this year or prior years affect your income statement? Yeah, so debt, yes, thanks, Rodrigo. That's the first thing. Debt with interest expense, right? So the first thing you need to think about is, okay, so that thing on my liability side, right, is going to be impacting my interest expense, and that's going to be affecting my net income, right? I'm not actually we're going to when we're going to be drilling into the income statements, we're going to deal this, but I want a high level approach very quickly, right? The other issue you're going to be having here, right, is fixed asset and depreciation. Thank you, Paula. Yes, that's it. The fixed asset and depreciation, that's the other way that the balance sheet is going to be affecting your income statement, right? And obviously, there's going to be some issues with deferred taxes, right? Or deferred income, right? Or prepaid expenses, right, that are usually registered in your balance sheet that are going to be affecting also your or flowing from your income statement, right, to your balance sheet, right, um, as part of the whole ordeal, right. As long as you accrue the expenses, or as long as you register the income, right, you're going to be a reduction on those assets and liabilities on the balance sheet and flowing your income statement as as an income, right, as a revenue, or as an expense, right? Not necessarily that that's generating a cash flow, right? Regarding the statement of cash flows, right, and we're gonna drill into this in a bit, right? But obviously, all the accounts receivables and accounts payable and inventory, right, which is the working capital, right, in your balance sheet, is going to be affecting your statement of cash flows if we are using the indirect method, which is the most common way to present the statement of cash flows, right? The interest expense that we just discussed over here, that is going to be in the income statement, right? Considering if it has been paid in the balance sheet, it's going to flow into your statement of cash flows, right? Any capex, right, that is going to be incorporated into the statement of cash flow, right, needs to be registered into your balance sheet as a fixed asset, as part of the whole ordeal that we're going to be having, right? So we're going to go into this in a bit when we jump into the different Excel spreadsheets and figure out how are different ones as a whole in general, right? But I just want to have a high level approach here of how the different financial statements interrelated. But without further ado, there's also going to be another one, the right, that I'm forgetting about here, right? Which is we're not, this is from an accounting standpoint, right? But we're going to be doing another one, or we're going to be doing a calculation, right, of the free cash flows, which is the main idea that we're going to be developing here. I forgot to pull that out. Have it with a blank here, right? And we're going to be using all three elements, right, to develop that free cash flow approach. If we are capable of coming out of the statement of cash flow, that's fine, right? but we're basically going to be using information from the balance sheet and income statement to come up with this free cash flow approach, right? That is going to allow us to correctly estimate the value of a particular company, right? That's what we're going to be drilling into in the coming weeks. Okay, so let me start with the two main approaches, right, that we're going to be drilling when we work into financial model, right? The first one is a top-down approach. A top-down approach means that you think about from a macroeconomics perspective, right? And then try to drill down, right? And figure out how much that's gonna be impacting my particular company, right? Considering that my company is gonna be very similar to the industry in general, right? And incorporating somehow, if possible, particular characteristics of the company, right? So we're going to start with a macro perspective if we want to think about it, right? We're going to evaluate a particular industry, right? We're going to start analyzing industry forecast. We need to incorporate seasonality as a whole, right? You are very familiar with seasonality regarding quarters, right? There are quarters where you have revenues, right? In particular industries, right? For example, retail, right? You're usually gonna have a spike in the month of May, so second quarter, right? You have Mother's Day and also Father's Day in the second quarter, but also you have in the December in the last quarter, right? All the Christmas shopping that is going to increase the revenues in those particular quarters as a whole, right? But also you need to think of seasonality and depending on the industry, right? Because if we're talking about agriculture, seasonality is not necessarily quarterly related, right? It may also be seasonality related to years, right? So there's going to be some year where you need to plant new seeds, right? Or rearrange all the plantation, right? Taking off the old plants and putting new ones as part of the way to rejuvenate that particular land, right? So that's an issue that we need to think about in terms of seasonality and also related from other industries such as capex, right? For instance, if we are talking about a particular manufacturing company, right, there's going to be some seasonality in capex every 4 to 5 years where you usually have to not only refurbish or repair particular machinery but buy new ones or new equipment, right? So those type of things we need to analyze using historical data, right, from the industry, right? I'm not going to start to jump into the company yet. We're going to using a top-down approach. And then we try to incorporate the company characteristics, right? Or incorporate the specific in particular. I'm gonna put some additional hints because obviously if you are doing the evaluation now as it's happening with a few of your classmates in investigación financiera, right, where they are doing the pitch for their company, they have a grim scenario in the next year, right? But what you normally need to do is, okay, we need to assume that there's going to be a rebound and come back to the normal or expected GDP growth, right? I'm also going to upload this. Let me just put that out. This is a report from Macro Consult, right? And this is the last report that I got regarding GDP forecast. Let me see if I can more, right? And what I was trying to explain is just we are expecting a decrease in GDP all across the board, right? And if you're valuing a particular industry, right? Right now you will say, hey, there's gonna be a significant decrease in manufacturing and services, right? As you will expect, right? But there's gonna be not so much of a problem with some other industry related to food, right? In general, as a whole, right? You're not expecting that much out to occur. But most important than that, and probably very helpful for your project, right, is the rebound that is expected, right? This is gonna be like a hip cap that we are expecting to form a V uh, graph, right, regarding it's evolving, right? So when one approach, for instance, right, and if we're valuing, for example, a company in the fishing industry, such as TASA, right? If we're going to be valuing TASA as a whole, what we're going to be doing is, okay, we're going to analyze, right, this from the sector and figure out, okay, we're going to expect a 2.1 decrease in general, and we're going to try to use that for the revenues of our company or free cash flow of our company as the expected decrease that we're going to be having, right? But also we're going to expect a rebound in the next year, right? As it's correctly pointed out over here as a whole. That's something that we need to take into consideration in general. But when are we going to be using this top-down approach most of the time? When are we going to be applying this, right, as a whole? Let me just curious. Uh, it's going to be most likely when we are doing a particular research from the company, right? Outside the company with no inside information or no particular access to managers of the company, right? So if you're doing research for a company right now here and trying to analyze a company worldwide, right? From here in Peru, right? It's going to be particularly difficult to get that insight from the company, right? Uh, you may want to start with a macro perspective for Uruguay, as I'm saying, analyze that particular industry in the country, right, and figure out where the typical things for the industry that may occur. When we are going to develop a few of our models, right, we're going to apply this top-down approach, right, but as I'm going to mention in a bit, I prefer the other one, the bottom-up, because it's more accurate in general. But if we are forced to use a top-down approach because there's no information available, we should not stay only at this level, right? The typical way that people develop this model, right, is they try to assume that the company resembles the industry and they leave it there, right? Such as the industry forecast and consider that as a whole. Or assume that the company is going to reverse to the industry regarding margins, right? Particular profitability margins, operating margin as a whole. And then in reality, you need to consider what are the company characteristics, right? As this company has a particular production process that allowed it to have a higher profitability margins than the competitors, right? Or is there a specific risk that I need to think about, right? To not necessarily incorporating the discount rate, because remember the discount rate diversifies specific risks of the company, but I do need to consider those risks on the free cash flows, right? Is there anything specific I need to consider when analyzing the free cash flow, right, as particular costs that are going to be affecting that forecast that we are developing? And the other approach that I wanted to highlight that I just mentioned is the bottom up, right? So the bottom-up approach, we're going to start from a micro perspective and then build it up. And the good thing about it, start a micro perspective, is that we can actually analyze the different intrinsic values of the company, right? Not only from the revenue standpoint, but also from the cost side, right? To figure out what is the profitability and cash flow generation capacity of the company. So in particular, we're going to have to drill down, and many exercises are going to build on that. What are the different specific products of the company and the different prices, right? Obviously, when you're going to be doing these valuations, you're going to figure out that, hey, there's 80% of the revenues or 80% of the value of the company is coming from 20% of the products, right? The Pareto equilibrium, right? That's applied also in the company production process, right? So there's going to be one main product or two main products, right, that generate the most of the value. The other ones you can assume constant, right? unless you imagine that there's going to be a significant change in the company environment or in the customer states regarding those products, right? We are going to incorporate the particular cost structure in the bottom-up approach, and we're going to see that in a bit. And we're also going to incorporate seasonality adjustments for this, right? Along with all the capital structure and financing requirements. Okay. Okay, so let's get into the Excel that I was promising that we have there on Blackboard, and this is going to give you a structure. I'm going to try to follow this a little more in the coming weeks that we're going to be using, right? Probably going to rearrange a couple of the items. There are some particular issues regarding each one of the companies that we're going to need to incorporate, right? But this gives us a heads on regarding the different elements that we have, right? First of all, I want to go into the global tab, right? Which is a nice way to work it out all the different problems that you are probably gonna run into. Let me increase the zoom over here. Let me do that, right? When dealing with months, quarters, and so on, right? In this particular model, I'm only using a forecast for 5 years, right? Um, Forecasts for 10 years are becoming more and more popular. But keep in mind that the farther you forecast something, right, the most likely it is that you're not taking into account uh, different issues that may arise in the future, right? It is clear, for instance, that several of the technology improvements that have occurred in the past 5 years, right? Some of them were not even considered, right? A lot of the contactless payment, right? All the increase in delivery, right, that we have right now, we're not thought about it, right? Or how many things are going to impact at several of the industries in 5 years time. It's a long way, right? It's a long run in reality. But the key element that I'm gonna show here, right, is that this is a good way, as I'm saying, to help you work it out the next financials that we're gonna be using, right? And in this particular format that I'm have put together, right? I'm using a template. It's coming up with a structure of income statement, balance sheet, and cash flow statement all in the same tab, right? For most of us, we are most accustomed to have a different tab for each one of the financial statements, right? It is this issue that we have that we like to have everything neat in one page, right? But we need to realize that actually these are only 175 rows in Excel, right? Out of 1,048,000, right? And there's a bunch of those rows that we are not using, and that's one of the typical cons that we have when we model stuff, right? We do not consider that, hey, our spreadsheet can be bigger, right? Regarding that. So what I was saying is this is a very good way to create arrays, right, in order to correctly identify what's going to be the different years, right, and how are we going to be calculating correctly the necessary information that we're going to be using here, right? A couple of things that do appear when we have this structure, right? And I recommend that to occur if you are working in with models, right? Is the dates that are used, right, should be the same columns, right, for every one of your tabs. So we were saying here, we're talking about year to 2020, right, 2020, right, in the income statement, right, and but also in the balance sheet and also in the statement of cash flow, right. But even if I have this in different scenarios, right, in different tabs, I still probably need to consider these, right, as the project for year 2020, this column, that's what I mean, right. So that's going to be a lot more helpful to track down an error, right? Because everything needs to be with the G column. Similarly, we're going to drill into this in a bit, right? This is the assumptions tab, right? And most of you are familiar with using an assumptions tab, or at least using assumptions space in a spreadsheet, right? Like a bunch of rows and columns that is going to be your assumptions chart. It's most useful to have an assumptions tab. And as you realize, here is December 2020, December 21 in column G and H, and the same things goes into the financial, right? And if I have these blank spaces here, right, that are we're going to be useful later on if we want to consider historical data to develop everything, right? Even if we have extra spaces, it is better for them to be the same column, right, in order to do this whole analysis as a whole when we are analyzing this. Let me jump into assumptions tab, right? And this is what I mentioned when I said, hey, we're going to do a high level or top down approach, right, when discussing this analysis. So for instance, this is a very simplified approach, right? Where we're going to have, okay, no seasonality adjustment for revenue related to the years, but some seasonality related to the quarters, right? You usually present information for the quarters and then build it up for the year. You can also do the other way around, right? That will depend on how much information you have available. It's obviously better to develop everything from a quarterly perspective and then move it back to an annual perspective. We're going to do that in a bit. But for the revenues here, for instance, right, this is a top-down approach, as I was mentioning, in which we have the historical data for the revenue, right? And we have some revenue growth rates coming up from the industry, if we want to think about it, right? And logically, this generates the different revenues that we're going to have in each one of the different years. There's nothing complicated over there. But logically, in order to transform this into the quarterly data, because it's useful to present quarterly data when analyzing a particular company or particular project, right? When we're going to be doing that, I'm incorporating the seasonality that has been estimated by us, right, in the coming quarters, right? And logically, the seasonality should come from historical data, right? We should come up with what has been the seasonality in quarters 1, 2, and 3 in the past years, right? In order to apply the same seasonality in the following years, right? There's nothing difficult here. That's an assumption regarding that, and obviously should add up to 100, right? Because this is how the revenues are deployed or received by the company in the coming or in the different quarters, right? That we're going to be having. And the same structure follows, right, in the following years as a whole. You may be wondering about this. Let me just go into the formula, right? If it's going to be big enough. You may be wondering a little bit about the formula that we have over here, right? Where we are basically using that particular forecast, right, in order to transform everything, right, from year 2020, right, in using that particular 40% for the first quarter. You realize that I'm using here the year count, right, that I have already assigned, right, in the global tab, right? In the global tab, we have assigned the year count formula, right? We have used that name. Let me just jump here into year count, right? For the whole period, which is A16 to IV16, right? All this whole line, right? It's taking into account that year count. And what's basically thinking about when we are developing this, right? Consider basically the information that we're going to be having here, right? In order to come up with the estimation that we're going to need for the first year, right? So it's counting out these 5 elements, right? And coming up with, okay, for the year 1, right? What's gonna be this, the 162 multiplied by the 40% as a whole. And we can do this in different ways, right? A lot of you probably are thinking, hey, here you can use probably an index function or a def function, right, to come up with this in an easier way, right? We also want to think about and use a sum if when considering different elements of the year that we are using to simplify this approach. But this is a very common alternative, right, to come up with correct estimation regarding this particular year. So here in revenues, I'm transforming these that we have from an annual perspective into a quarterly perspective, right? I'm gonna go very quickly because this is just a template for an example, right? But we're gonna drill into this in the next weeks, right? But logically, if you are talking about a top-down approach, sorry, we have a slight nice bird over here just chipping, right? What we're gonna have here is usually what's going to be at the percentage of cost of goods sold, right, per each one of the annual, right? Usually you need to adjust for the variation seasonality, in this particular case 100%, so we need to do that in general. But similarly, right, we are gonna be considering the different approach. And here, this is what I wanted to point it out, right? Uh, 1 second, right? Because I'm going to be using here in year 1 the 58% that we assume, right, as the cost of goods sold over revenues in general. You may develop, as I was saying, right, the quarterly data. Based on that and based on the revenues you have calculated, you're going to develop the quarterly data for each one of the different quarters in the following year, and then add it up, right? In this particular case, the formula is adding the quarters to the annual, which is the usual way to do it. Let me increase the font. Realize it's very small in the screen. To come up with what's going to be the cost of goods sold in each one of the years, right? And similar things occur with the overhead as a whole. We are going to be, and let me just quickly mention this because we're going to drill into this later on. We are going to be using some key financial ratios, right? Some such as receivables day, inventory day, days of inventory, days of accounts payable, right? As a way to correctly estimate or what's going to be the accounts receivable, cuentas por pagar, the inventory, and the accounts payable, right, for our forecast, right? And this is how we're going to be forecasting the working capital accounts, right? The working capital accounts that are going to be needed when we are going to be developing the necessary elements in our balance sheet and then in our statement of cash flows, right? We also going to be thinking about impacting, right, this forecast with CapEx, right? And in the case of CapEx, we are going to be implementing or making some assumptions, right? And in most cases, people assume a CapEx a percentage of revenue. It is better to consider historical data, right? And consider the seasonality adjustment. And then please go ahead and check it out. Excel spreadsheet, and you're going to realize that, for example, all the capex has been assumed to occur, right, in the second and third quarters, right? It is unlikely that the capex happen in each one of the different quarters, right? Or at least not in the same degree, right? There's going to be a lot more capex in a particular quarters than others in general, right? We are going to be drilling here. And one other thing that I wanted to point it out, right, before wrapping up, since we are 9:17, let me just give a few more minutes, guys. We are going to have some checks, right? For instance, here I have developed a check for assets equal liabilities plus equity, right? The typical check that we're going to be having. And logically, it has a conditional formatting, right? That in case there is no problem, it's okay and it's green. And if there is an issue, right, we're going to need to be checking from reviewing that there's a problem here. Obviously, what I have not done here is I don't have created the necessary elements in order to clear right this problem and simplify this effect right between the different financial statements. That's what is being generated over there, right? I have put a typical balance, by the way, with cash flow, debtors, right? That's debtors that we're going to have here, right? Accounts receivables as a whole, inventory, long-term assets, investment, deferred assets. So this should be better rephrased as receivables more than debtors before coming out. Receivables net, yes. Before it can be confusing if we go with debt for trade credit, earnings advances, short-term revolver, long-term bond debt, long-term bonds, other liabilities, total equity as a whole, right? But one thing that I wanted to point it out, right, is here in financial, and it's just for the sake of presentation, right? You're gonna see this happening in a few financial statements, particularly for companies overseas, right? Particularly for companies abroad, right? That usually present the balance sheet in a different way, right? And what they normally do, right? What you're going to be realizing is they start with assets, long-term assets, that's fixed assets, right? Uh, investment, create a working capital structure. Realize that they are not building the typical assets and liability structure that you're familiar with, right? But they try to come up with what is called net assets, right? All these elements, right, as you are seeing, are assets minus the liabilities, right, relating to working capital. So what we are going to be coming up when we analyze, right, that's going to give us the situation for the company, right, in the working capital structure. We're going to have all the trade creditors helping us on that, the net working capital that we're familiar with, and then we consider the financial position, right? Why are we coming up with this, right? By subtracting asset minus liability is a different way to come up with a similar as equity, right? The net assets portion, right? And the reason I'm presenting this is that you're going to see this, for instance, in Europe, right? Most likely in Spain, France, and Germany companies, right? Where you are going to be valuing, if you're valuing a European company, the structure that you're going to see on the balance sheet is not going to be similar to the one that we are familiar with, right? But you just need to pick up the different accounts to come up with a financial that is more similar to the one that we are analyzing, right? And the reason they are doing this is just to come up with a net assets portion, which is going to be very similar to the one that I posted, right? And consider that similar to the equity as a whole, right? Okay, so please play with this or just quickly review this Excel. I don't want you to play. Get familiar with a couple of the acquaintance, right, of the issues that we are putting on here. And as I mentioned, I'm going to post a case on exercise tomorrow, right? And we're going to solve that. And it's basically related to revenue forecasting, right? So we're going to use, as I mentioned, the bottom-up approach, right? We're going to not go with a top-down. It's better to start with a bottom-up, right? And come up with a better valuation for our whole company, right? And we are gonna be, let me just quickly go over here, right? What we're gonna be doing is start with some specific information on product and prices, right? That we are gonna need to forecast and come up with different revenues. And then we can actually incorporate all the seasonality and figure out what are the critical drivers that we are gonna need to consider, right? Because the critical drivers then are gonna be the one that we're gonna be using for all the scenario analysis that we're going to be performing, right? So, without further ado, and sorry that it took a little longer, let's wrap it up over here, unless there's any question that you want me to answer. Let's meet next Tuesday. As I mentioned, we're going to be doing not the examination, case by case, exercise by exercise every week, right? The main idea is for everybody to figure out what's the best way to solve this. I'm happy to hear if you have a better way, or is the one that we're looking for, sound a reasonable way to come up with a better valuation, a strong valuation in terms of evaluating this, right? Uh, so see you next Tuesday, everybody, and I hope you have a great week and great start of the semester.